The Reserve Bank's MPC is meeting in a backdrop where the global central bankers are worried about the banking crisis in the US, and we've already seen the Fed introducing some moderation in its hawkishness. As always, CNBC-TV18 Citizens MPC meets ahead of the RBI's MPC to discuss the issues that confront the MPC. I have with me Chairman Pronab Sen and members of the Citizens MPC, Samiran Chakraborty of Citi, Sajjid Chinoy of JPM, Soumya Kanti Ghosh of State Bank of India, Sonal Varma of Nomura, and Dr. Pronab Sen, of course, the chair. Gentlemen, and Sonal, thank you very much indeed for joining me. Sonal, actually, let me start with you. The global backdrop is what we have to discuss first, and as we noted, the Western banks have introduced some kind of moderation. Do you think that that will impact the MPC when it sits in judgment of our situation?
It should have an impact, Lata, because when the February policy was being decided, I think the backdrop looked a lot more favorable with, talk of soft landing, no landing, China reopening, triggering higher commodity prices. Things have played out differently. So on the growth front, with the current banking sector stress, there's still uncertainty on how this actually plays out. The good scenario would be that the policy responses done so far curtail any further increase in financial stress, which is our current baseline. But there is, of course, a risk that as rates stay higher for longer and growth slows, we see more financial risks evolve. But I think the important point is that in either of the scenarios, it is likely that banks are going to tighten their lending standards. Small and regional banks will see their NIM, come under squeeze, and their lending to the smaller firms or commercial real estate. And I would say just broadly, lending standards, which were already being tightened even before SVB happened, will be tightened further. So the credit channel is going to mean lower bank lending as well as lower growth. And our base case is very much still a recession in US, but also in Europe. We're looking for a mildish kind of a recession, but nevertheless, it is still very much a recession. So in terms of the global growth assumptions that were made in February, now it looks like global growth is going to be weaker than that. And therefore, for India's own growth outlook, it means there is downside risk. Two, I think despite China's reopening, oil prices have not gone up relative to the current assumptions of 95. And therefore, I think given lower global growth and contained commodity prices, which is our view going forward, the risk for inflation, despite the upside surprise in Jan-March, is also to the downside for FY24. And three, the first 2 points actually do mean, in our view, that Fed is largely done with its rate hiking cycle. As far as the external conditions from the current account and the external dynamics are concerned for India, that also looks a lot more favorable today.
Oh, okay. Well, Samiran, what's the Citi view? I think you'll have a more benign view of global growth. Will global growth be so bad that the Reserve Bank will have to take that into consideration and, be more dovish?
So, Lata, first, the situation is very uncertain. It is difficult to thumb the table and say exactly how this is going to play out. But if you just simply look at the global growth picture, the Jan-March quarter growth has been much higher than what anyone would have anticipated. And that's why, despite us downgrading the latter part of the year forecast to some extent, the full year global growth forecast around 2.2%, that remains practically unchanged. The second part is that because things are very uncertain, I think the central bankers across the world are taking a view that we will pick up the pieces just in case something breaks, rather than taking a view that we will act before it breaks. So my sense is that going forward, monetary policy is going to be more reactive rather than proactive in a situation like this. And then we expect RBI to also follow the same pattern.
Okay, so let's then concentrate on the MPC's mandate, inflation. Already the word core inflation has crept into their stance, and that is not showing any decline. February inflation was way higher than what the street or RBI estimated. So, Soumya, will that be a very important factor for the MPC, that inflation is not going as per their forecast?
Yeah, thank you, Latana. I think core inflation getting sticky, that story is unlikely to change. We need to understand, but behind this, why it is getting sticky, and that's a fair point which the central bank has been making, because core inflation is persistently sticky at around 6%. But we need to separate the noise from the data and the wheat from the chaff, whatever you said. If you look into the period from January 2012 till February 2023, the decade, the core CPI average has been 5.84%. And I can see 4 to 5 distinct phases where the CPI is actually, if you remember, in the early Jan 2012, the CPI was in higher tens, then it collapsed to 4%, then it again went up to 6%, then it again went up, collapsed, and again was at 6%, now it's 7%, now it's 6%. Now, if I just take 2 periods out of this, from January 2012 to February 2015, when the numbers went down from 10.3 to around 4%, yes. And from February 15 to June 2018, when the number went up from 4 to 6.5% whereabouts, there was a movement of around 600 basis points in core inflation, and the transport and communication part had contributed 20% to it. Instead, in fact, that is the story across all core inflation cycles, the transport and communication part contributing at least 15 to 20% of the increase or decline in the core inflation.
So how about now then?
So now the point is that this component is unlikely to go away, because if I understand properly, crude oil going up and going down is unlikely to make any meaning to the RBI inflation trajectory until and unless the government cuts the fuel prices. But that is not going to happen. If that doesn't happen, I think core inflation is unlikely to decline meaningfully to below 5.5% by the year end. So by that logic, if we buy that argument of core inflation becoming sticky, we may have to see several rate hikes, not one in this policy.
Okay, so that's not argument enough to keep the rates, keep on increasing rates is your point. Okay, now we'll come to the growth question. Sajjid, the Reserve Bank's bulletin, March bulletin, seemed fairly confident on the growth story. If you're so confident of growth and your inflation is coming higher than expected, you should hike rates. Are you as confident, and do you think the MPC will be as confident? We didn't get that from the minutes of the external members.
Morning, Lata. Good to be here. I think I just want to first reinforce the global point that Samiran made, that the first quarter of this year is tracking 3.5% globally. Remember, this was the quarter when we were expecting a big recession. And in fact, global growth has accelerated over the last quarter. So there is a certain resilience to advanced economy, private sector balance sheets, which I think analysts have consistently underappreciated. And that has meant that at least advanced economy central banks will pursue 2 objectives and 2 instruments. That yes, if there are financial stability concerns, they will use regulatory tools to get after them. But because growth is holding up so well around the world, and inflation has been so sticky, core inflation has been so sticky, they still have to persevere with their rate hike, which is what the Fed did, the ECB did, the Bank of England did. In Asia, you've seen Thailand, Philippines, Taiwan. So this will have to be horses for courses. I think some of the global strength in the first quarter is showing up in India. We had a strong exports number last month, both for goods and for services. But we have to expect that growth will slow at some point in time. The combination of policy normalization at home and the fact that at some point global growth is going to soften will not bypass India. The question is, will growth soften enough to bring inflation down decisively to the point where it becomes shock-proof? What we've seen is a series of shocks the last 3 years, and each time inflation goes above 6%. The reason I worry about core is that repeatedly we have found that core is your best predictor for future headline, that it's headline that converges to core, not the other way around. So I think the RBI won't be able to take comfort from the fact that because of favorable base effects, headline CPI is dipping to below 6% for the next few months, if core is going to be in the 5.5 to 6% range. Yes, we have to worry about an anticipated slowdown, but the trade-off is there is a probabilistic future We don't know how deep the slowdown is going to be. We don't know what the disinflationary impact of that's going to be. And you have to trade that off with a current where we've seen currently sticky core inflation, which is certain. So there's a certain problem at the moment with an uncertain future. And therefore, I think the RBI may well have to focus on the here and the now.
Okay, got that. I think there are slightly nuanced differences over here with Sonal expecting things to be much softer and Sajjid and Samiran, I think, expecting that both growth and inflation are not going to oblige and could be a little higher. Dr. Sen, how are you looking at the scenario? Is the Reserve Bank to be more worried about inflation, which is their mandate?
Well, there will be. I mean, the fact of the matter is that on one hand, as everybody's agreed, the core is sticky. And the other is, I think we are at the moment looking at a very high probability of food prices going up. And that's something that they're going to have to factor into account. I mean, despite the sort of soothing noises that the government has been making, the fact is agriculture, particularly in the northern part of the country, isn't doing very well at all. So we have to be careful about the inflation story. As far as the growth story is concerned, I think that the uncertainties are too large. But even taking into account those uncertainties, my sense is that the growth is going to soften going forward. And I don't see it upticking to anything really large for a while yet. So I would at the moment worry a little bit more about inflation than I would worry about.
Okay, I'm getting a sense that this MPC is going to vote more in favor of a hike. But just to add to that inflation part, Samiran, there are, what Dr. Sen is pointing out, already milk prices are rising every month, but there are some weather-related fears as well.
Absolutely. So it's not just milk. I mean, we have already got some data on something like tur dal, etc., some pulse prices going up. Sugar prices globally has shot through the roof. And now we are dealing with a February heat wave, a March unseasonal rain, and then we will be looking for whether it's an April-May El Nino situation or not. So the weather-related shocks and its impact on food prices would be something that will be there at the back of everyone's mind.
Okay, so the chances of inflation remaining higher than the Reserve Bank's trajectory is a possibility. On that note, we have to take a break, but we have to understand how this MPC is going to vote on the rate hike and what will be the stance of both the official MPC and ours. All those questions after the break.